go over this trade. This is S&P futures trade, which I was looking to go long in. So you can see here, came into the zone. Now, I was completely wrong in this trade. I just want to show how good trade management will still, save you in a trade. Even though I was completely wrong and it actually tanked from here. But here you can see here we've got, I'm just setting up the risk parameter. So I've just done it graphically here. You can see that's the risk, that's the entry. Let's just stop here. It's come into the zone here, and then I've just copied and pasted this box upwards so we can see where the one-to-one is. So normally on a day trade, what I do is I will go to break even plus entry plus tick, which covers the commissions at a one-to-one. You can see we've hit the area. You can see here it's going in the right direction at the moment. So we've got in with 3 contracts on this one. So I'm just following this with the commentary. So you can see here that's your one-to-one here. So we're getting pretty close to your one-to-one. Not quite hit it yet. So just setting that again here. It's getting pretty close. Not quite got there yet. Still waiting. Through in my line, at which point I will be moving the stop loss here to the entry, which is here, plus the 1 tick, which again is just to cover the commissions. You see it's getting pretty close. It's trying to get up there. Not break even rice, it's break even price. So change that. Which is at one-to-one. It's not quite got there. You can see it's very process driven. It's there's no ambiguity in it. We're in this trade. We've gone long on the trade. Now the market has been rallying from here. We still stick to our trade management rule. Sometimes it works against us. It'll hit the one-to-one, come back, retest the zone, go even a bit deeper, and then it'll go and hit all targets. But that's the risk you take, as long as you've got some rules around it and you stick to those rules. And that's the important thing, is knowing how to follow a procedure, ABC, and seeing it through. See, the risk on these 3 contracts is $487.50. That is the difference between the buy price, which is 48.1775, which is here, and your stop price, which is here, which is 48.1450. And then what you do is times that by 50, which will give you the price risk per contract. And then obviously we've got 3 contracts, so we times it by 3. That's the total amount of risk in the trade, is $487.50. Stop loss is at 487.50. So obviously we've hit target 1. What I've done is, you can see here, I've moved my stop losses for all 3 contracts to the entry price plus the 1 tick, which will cover the commissions of the trade. Stop move to entry plus 1 tick. So the tick is the smallest increment move of a particular asset that's in the futures market. So, for instance, in the Forex market, it's known as a pip or a pipette, which are the smallest increment moves. Here, it's known as a tick in the futures market. The tick value is different depending on which asset you're trading, whether it's gold or any of the commodities, or whether it's one of the indices or the Forex futures contracts. They're all done in ticks, but each asset has a different value. So for example, the S&P is $12.50 per tick. There's 4 points, 4 ticks and a point. So that's where we've got the value from. So you can see here it's gone through. And then what we'll do, we'll come back at the end to see what actually happened in this trade and how I was completely wrong in the direction. So let's come back to this trade, do a review on that S&P trade. You can see here, came in, went up, went to the 1-to-1, so we moved our stop, break even 1, and then it basically collapsed from there. So it's completely wrong in the trade. But as I said before, having a good trade management plan saved me on this. Thank you for watching.